A $9 stock just absorbed a near $500 million drone company. Share count jumped. The multiple shrank anyway. That gap is the trade. Stay with this. I'll show you the line on the balance sheet holding Redwire down, the event that closes the valuation gap, and the one number to track in the next earnings print. Before we get into the names, do me a quick favor. If you want in-depth market analysis that goes beyond the headlines, subscribe to Stock Pulse Alpha and turn on notifications. Every week, we break down high-conviction investment opportunities, market trends, and long-term strategies designed to help you build wealth with confidence. Join the Stock Pulse Alpha community. It only takes a second, and it helps this content reach more serious investors like you. Quick check before we go further. Pull up Redwire's share count from a year ago and from this quarter. Hold the difference in your head. We come back to it in 60 seconds. The pitch you hear most often is that Redwire is a sleeper, a name the market hasn't found yet. Look at the holder list. In the most recent 13F window through Q3 2025, Redwire's filing aggregates show majority institutional ownership, with broad index complexes like Vanguard and BlackRock sitting in the top holders alongside several space-themed ETFs. Sell-side coverage is active too. Cantor Fitzgerald, B. Riley, and Roth Capital have each published research on the name with updated price targets through early 2026. This is not a stock the institutions missed. It is a stock the institutions priced in spite of seeing every line in the filings. What changes for you as a buyer is the edge. If your thesis is, they haven't noticed yet, that thesis is already wrong. The thesis has to be that the institutions did notice and chose to discount specific risks you can name. So this week, pull Redwire's latest 13F HR aggregate from any free filings tracker before you place a single share order. Here's the part of the Redwire story that holds up to every layer of scrutiny. The rollout solar arrays attached to the International Space Station, the IROSA wings extending the original truss panels, are Redwire-built hardware. The mission paper trail is real. SpaceX CRS-22 in June 2021 carried the first two IROSA pairs. CRS-26 in November 2022 delivered the next pair. CRS-28 in June 2023 carried the final set. 6 wings, 3 Dragonflights, all currently generating power on the station above your head right now. Not a partnership announcement, not a press release. Hardware bolted to a structure orbiting Earth at 17,000 miles per hour. Why this matters for the trade? When a SpaceX-themed ETF launches after the IPO, its rulebook will demand documented launch vehicle integration, not a supplier relationship pitch. Redwire clears that bar 3 times over. Before you compare Redwire to any other space supplier on your watch list, check whether their hardware has actually flown and on what specific mission number. Redwire is no longer just a space hardware company. In June 2025, Redwire closed its acquisition of Edge Autonomy, a defense drone manufacturer best known for the Stalker family of small unmanned aircraft used by the U.S. Marine Corps and U.S. Navy. The reported total deal consideration was roughly $925 million, a mix of cash and Redwire stock. That changes the company you own. Pre-acquisition, Redwire's revenue was almost entirely space hardware, lumpy by contract, exposed to NASA budget cycles. Post-acquisition, defense drones contribute recurring revenue, with Edge already booking over $20 million in follow-on Stalker orders in the first quarter of 2026. That diversification is the bull case the management team is selling. It is also exactly what triggered the share count event we're about to walk through. Open Redwire's 8K filing dated June 2025, and read the section labeled Consideration line by line before you size any position. Picture 2 people staring at the same Redwire 10Q. One looks at top-line revenue and sees rocket fuel. The other looks at the diluted share count footnote and sees the break. Same company, different stock. Before the Edge Autonomy close, Redwire's diluted share count, per its early 2025 filings, sat in the upper double-digit millions. After the close, with stock consideration issued to Edge holders plus convertible activity tied to the financing, the diluted count moved into 9-figure territory. Call it a 40 to 60% expansion on a per-share basis, depending on which footnote you pull and how the convertibles are treated. Total revenue went up. Revenue per diluted share barely moved. That is the entire mechanical reason a name with a fatter top line is still trading near $9. The business got bigger. Your slice got thinner. When you compare Redwire's multiple to Rocket Labs or Planet's, do it on enterprise value to forward revenue, not market cap to trailing, and pull the most recent diluted share count footnote first. Watch what the index funds quietly did. The iShares Russell 2000 ETF and the Spider S&P 600 Small Cap ETF, both rules-based passive vehicles, expanded their Redwire positions through 2024 and 2025 as the float grew. That is not a conviction call, that is a mechanical inclusion driven by the very share issuance we just talked about. Then on the active side, the Procure Space ETF, ticker UFO, kept Redwire as a constituent through both the announcement and the close of the Edge Autonomy deal. Passive bought it, active held it. What does that tell you? The people who scrutinize space sector exposure for a living looked at the dilution, looked at the defense pivot, and chose not to sell. They also did not panic buy. That is the behavior of holders who think the story is still developing, not the behavior of holders who think the bottom is in. This week, look up the most recent UFO ETF holdings PDF on the Procure Asset Management site and check Redwire's weighting against the same date last year. Hold that thread before we keep going. If this breakdown is sharpening your read on Redwire, hit subscribe. The second half is the one that matters, where we name the trigger that closes the gap and the headline that breaks the thesis. Why does Rocket Lab trade at roughly 75 times trailing revenue, while Redwire trades near 5.5? The honest answer has three parts, and none of them is the market hasn't noticed. Multiples price the future, not the past. First, Rocket Lab has Neutron, a medium-lift reusable rocket with a publicly tracked development schedule and a first flight window inside 2026. That is a single binary catalyst the market can underwrite. Redwire has no equivalent single catalyst, it has a portfolio of smaller wins. Second, Rocket Lab is a pure launch and spacecraft pure play. Analysts can model it on one revenue curve. Redwire, after Edge Autonomy, is a two revenue stream company, harder to model, easier to discount. Third, Rocket Lab's share count is not absorbing a fresh acquisition. Redwire's is. None of those three reasons is permanent, which is exactly why the gap is closable. Build a side-by-side spreadsheet this week with 3 columns covering Neutron progress, segment level margin, and share count, then update it after each company's next earnings release. On one side of the Redwire balance sheet, the backlog is at a record level. Management has cited a committed work figure north of $300 million in the latest quarterly call. On the other side, the operating cash burn has been real and persistent, with adjusted EBITDA still negative in recent quarters even as revenue climbed. Backlog feeds the future. Cash pays the rent. When a small cap runs an EBITDA deficit alongside an acquisition, the next financing event is never far off the table. That is the risk the institutions priced when they discounted the multiple, not the IPO narrative, not the SpaceX exposure, but the math of a runway that depends on integration revenue showing up on schedule. If Edge Autonomy contracts convert to cash on the timetable management has guided, the runway extends and dilution risk fades. If they slip, another raise is on the menu. Pull the most recent quarterly cash equivalence line, divide it by the trailing 12-month operating cash burn, and write that runway in quarters on a sticky note before you do anything else. Here's the part most analysts miss. The catalyst that re-rates Redwire is not the SpaceX IPO bell ringing. The catalyst is the first quarterly report where Edge Autonomy revenue is fully integrated, the segment level operating margin is positive, and management does not have to add a one-time adjustment to make the print land. That earnings night is the trigger. Why this specifically? Because the dilution discount we walked through only unwinds when the market can see that the new share count is producing per share earnings power. Until that proof point lands, every revenue beat gets discounted by but the share count. After it lands, the comparison to Rocket Lab stops being absurd and starts being a fair fight. Watch for two things on the next earnings call: the defense segment's organic growth rate and the trailing 12-month free cash flow line crossing towards zero. Add Redwire's next earnings date to your calendar the day the company announces it. Set an alert 1 hour before the print and read the segment breakdown before the conference call audio loads. Documented, mission-proven hardware is not just a marketing phrase. It is the inclusion criterion that decides which tickers land inside a SpaceX-themed ETF basket and which ones get screened out. When a fund construction team writes a rule that says, quote, the issuer must have delivered hardware flown on a SpaceX launch vehicle in the past 36 months, Redwire passes that test on 3 separate Dragon missions. Filtronic does not. Redwire does. That distinction matters in dollars. A typical sector-themed ETF inclusion drives forced buying equal to several days of average trading volume, concentrated over the rebalance window. For a small cap with a float in the 9-figure share range, that kind of mechanical demand can compress weeks of fair value adjustment into a single trading session. The exposure is asymmetric because the rebalance happens regardless of whether the operator wants to buy. Rule-based funds do what the rule says. Track the launch date filings of any new space-themed ETF. The prospectus posted on SEC EDGAR, and read the inclusion methodology section before the rebalance, not after. Picture 2 scenarios landing in the next 3 earnings cycles, and you can pre-write your reaction to each. Scenario 1. Redwire reports an integrated quarter where total revenue clears $125 million, defense segment organic growth is double-digit, and the company guides forward without naming a new equity raise. That print confirms the thesis. The multiple has every excuse to expand. Scenario 2. Integrated revenue underwhelms. Segment margins stay negative for the 3rd quarter in a row, and the 8K filings show a fresh shelf registration in motion. That headline ends the trade. The smart move is not picking the winner before the data lands. The smart move is writing both reactions down now, while you are calm, so that when the print drops at 4:05 p.m. Eastern, you are reading numbers, not feeling them. Asymmetric setups are only asymmetric for the people who already decided what each branch means. Open a text file today, label it RDW Playbook, and write 2 paragraphs, one for each scenario before the next earnings date crosses the wire. The spine is simple. Redwire owns documented SpaceX exposure that nobody can argue with. It also carries a real dilution overhang from the Edge Autonomy deal and an operating burn that demands integration revenue on schedule. The market is pricing both, The next clean post-integration earnings print is the moment the multiple gets to decide. Track the segment numbers, not the IPO headlines. Before you leave, do 3 quick things for me. First, hit that like button if this analysis gave you something to think about. It genuinely helps Stock Pulse Alpha reach more investors who are serious about building long-term wealth. Second, subscribe to Stock Pulse Alpha and ring the bell if you haven't already. We publish in-depth market breakdowns, stock analysis, and high-conviction investment ideas every week, and you won't want to miss what's coming next. Third, leave a comment and let me know which sector you'd like us to cover next. I'm working on a deep dive into an opportunity that most investors are completely overlooking in the industrial automation space, and that video is coming very soon. Until then, stay curious, stay disciplined, and remember, price is what you pay, value is what you get. Thanks for watching Stock Pulse Alpha. I'll see you in the next one.